Hello, everyone. Bruce Morris from the TAB Group here, and welcome to TAB Forum's Market Structure Wave. Today's conversation focuses on developments in fixed income trading technology. Today, we are very fortunate to have Vuk Magdelinic, CEO of Overbond, join us to discuss this dynamic market structure subject. Hey, Vuk, welcome to TAB Forum.
Thank you, Bruce.
To get our conversation going today, Vuk, can you share with our audience a little bit about yourself and Overbond's position in the marketplace?
Thank you. Of course, Overbond is a quant analytics firm. We help automate credit trading workflow. So data product that aggregates and then models fixed income data elements sourced from both pre-trade and post-trade data feeds in real time, applying AI as well as relative value comparisons so that traders, bond traders in corporate credit, can discover liquidity, best executable price, and then respond to their inquiries if they're on the sell side, or initiate trades on the buy side more efficiently.
Vuk, can you level set the state of the fixed income market from a technology standpoint?
It's hard to be profitable in bond trading operation these days. Markets are suffering from illiquidity, especially in corporate bond sector, which is the sector that Overbond focuses on. And in particular, recently, due to rate hikes, inflationary concerns, commodities pricing spike, and now the latest, some FX changes on a macro level. So it is increasingly difficult to be profitable running a trading operation that needs to execute many trades or many legs of trades during the day, and do so efficiently, with speed and precision. So some level of automation is required in this workflow so that the trading operation can, run, let's say, hundreds, if not thousands of trades a day in a semi-automatic format, especially on the sell side when it comes to responding to RFQs in a timely manner. And then I would say also, especially in the RFQ responses that are now not just for the price liquidity discovery and validating that indeed those responses are best executable, but also margining on the sell side, which kind of knocks out, let's say, the workflow to be fully end-to-end automatic.
Can you share or talk about some of the more innovative and or leading edge examples from Overbond that you're seeing that would be beneficial for our listeners?
Absolutely. Thank you, Bruce. So we've launched an add-on, which is the AI model for margining for the sell side RFQ responses, where the features in that model were, classic RFQ data elements. And I'm talking about request for quote data elements. What is the counterparty? How many dealers are put in competition? What is the venue that the RFQ is coming from? Ultimately the bond and the spread on that bond and that given tick. This real-time analytic obviously aggregates market level data information and is necessary for more efficiency on the credit trading desk on the sell side, as I mentioned. We launched it last year as an add-on. It was mid-2021. And fast forward a year later, our data science team worked really hard to add two breakthrough features into that model, increase its coverage, precision, and ultimately speed in real time, so that the margining can be done now end-to-end automatically. We call it auto margining. So what are those two features? First one is measuring the unit of market risk on a macro level, as well as the sector-specific level, issuer and then bond or security level, in order to obviously margin with the optimal P&L for sell-side dealers in days or market moments of heightened risk or market neutral, or what we call normal risk. This is optimized across a historical data set that goes 1-2 years back on post-trade data, and has ability to refresh and observe those data elements and still provide an auto margin within real time or one tick. Now, the second one that I wanted to highlight is the notion of the sensitivity of the margin or the P&L to the trade size. It's easier said than done because we have trades of various sizes, and in post-trade data, such as, for instance, trades in USD, trade sizes, let's say, larger than 5 million are masked. So to train this model and incorporate true sensitivity to trade size was quite a novel and I'd say a modeling breakthrough for Overbond data science team. But indeed, this feature has proven to increase precision of auto margin model quite drastically, and we're excited about the now ability to provide to all of the Overbond sell side brokerage clients ability to auto margin on top of auto response to the RFQs.
How does this technology either or both add liquidity and or mitigate risk for the marketplace?
Well, in a simple way, if we're now removing this bottleneck in auto margining on top of auto responding to RFQs, simply we can now purely passively or automatically respond to more RFQs. More RFQ responses lead to more ability from the dealer desks to service clients, and more trades and more efficiency in the marketplace overall. That is a good thing for liquidity, and we do feel that it has innate liquidity impact or positive liquidity impact. I would also highlight that given that the flow on the sell side is mostly now agency flow, the ability to have more sensitivity in terms of the P&L capture per trade will lead to these businesses being more profitable, and that is also a good thing in terms of the overall electronification of the fixed income corporate credit workflow.
Vuk, thanks so much for sharing your time and insights with Tab Forum today. And to our viewers, thanks for stopping by for what was hopefully an educational and entertaining ride on Tab Forum's Market Structure Wave.